Okay, it is now just a minute or two after the hour. It looks like our participants have stabilized, and so I just want to officially welcome you. My name is Chip Edmonds, Executive Vice President here at the college, and you're in for a real treat today. This is an opportunity to sort of dig in and learn a lot about one of the most important aspects of the institution, and that is our endowment and the role that it plays in both operating and maintaining the health of the institution and supporting of students for the long term of the institution. And so we have two very special guests with us today. I first would like to introduce Mr. Don Hughes. Don, thank you so much for being with us today. Don is Vice Chair of the Board of Trustees, very significant career that he had largely in the private equity space, most recently with Camden Partners, where he retired as a CFO. He is also has served as a chair of the investment committee of the board and has taken a leadership role in stewarding these resources for the long-term health of the institution. Also with us today is President Ken Trachty, who of course has been here since 2013. And so pleased that he was able to carve out some time to also share in today's discussion as we together learn more about the role and impact of the endowment and your role in support of that as an engine for this institution. So I also want to acknowledge, and Rob, if you go ahead and put our presentation up for today, I want to thank my colleague Rob Dietrich, who has been helpful in putting today's sessions together. And we hope that you find this quite insightful. And we do want to leave time at the end for questions. So as we go through these slides together, please ask some questions, to be prepared to ask some questions, either what's presented here or other things that may be of interest to you. Just real quickly, Rob, if you go to the next slide, we'll just give you a quick overview. And so here's our agenda for us today. And I will also mention that today's session is being recorded. So we will have this after the session today to put on our website and to share with those who may have an interest in learning even more after today. So we're going to look at our endowment in context. And of course, the endowment, its purpose, performance, and process and impact. And then we'll turn it over to you, our guests, for some question and answers. And I will be pleased to moderate that session together. So to start us off, I turn it over to you, President Trachty.
Thank you, Chip. I'm glad to be here and particularly pleased to be joining Don Hughes, who I've had the pleasure to work with in his role on the board since I joined the institution in 2013. And I'm going to provide, as Chip indicated, some context, which will then allow Don to take a deeper dive into certain aspects of the endowment. The first thing really to understand is that for institutions of higher education, there is a draw on the endowment that functions as a source of revenue. And the slide here is designed to illustrate kind of the relative importance of that to the college's operations. Now, I will say that the numbers referenced in this slide are from the current are from fiscal year 21, which is a year that was impacted obviously by COVID. And there's perhaps the percentage contribution of the endowment is probably slightly overstated because net tuition and room and board revenue were down as a result of the way COVID impacted enrollment across higher education, including Lycoming College. But the point here is whether it's 21% or 27%, the endowment functions as an important source of revenue. To be more precise, the draw on the endowment functions as an important source of revenue, and that's something that Don will elaborate a bit upon when I turn the presentation over to him. Now, one of the things to understand about Lycoming's endowment is that it is a source of relative strength for the institution. So in higher education, when we consider the strength of an institution, there are a variety of factors we can look at. We can look at the number of applications the institution receives. We can look at annual fundraising, alumni participation, the academic credentials of the entering class. What's important about the next couple of slides is that when you look at endowment per student, which is really the best measure of how impactful your endowment is, Lycoming ranks, as we will see, well within the top 100, indeed not far behind the top 50 of the National Liberal Arts institutions. And it is, along with performance on graduation rate, actual versus predicted, it's one of our two greatest strengths as an institution, as we both compete for students and create access for students. As you can see, as a result of what Don will talk about a bit later, in the most recent year, there has been a significant growth in endowment per student, such that we are nearly at $230,000 per student in the value of our endowment. Let's move. So a little bit of context. I mentioned that this is a relative strength for us. And what we did on this slide is we picked several other institutions, all of which are in the state of Pennsylvania and are in some sense competitors for us. And we show Lycoming's endowment per student relative to those others. Now, Lycoming's overall ranking in US News is around 120th, as we have communicated to you. In endowment, just to give you a sense, Gettysburg, which has a lower endowment student per student than us, is ranked about 54th in US News overall, while Dickinson College, which is slightly higher than us, is ranked just into the top 50. Both Susquehanna and Juniata, as you can see, have significantly lower. In Juniata's case, only about half per student, and in Susquehanna's case, even lower than that. Juniata is ranked about around 80th overall, and so you can see in this measure, we are much stronger. And then, of course, Bucknell and Haverford are at the very high end of the scale. I was looking at some data last night, and of the institutions in the Commonwealth of Pennsylvania, Lycoming is 11th overall, and the only institutions that have a stronger endowment per student are places like Penn and Haverford and Swarthmore and so on and so forth. So this really is a strength for Lycoming College, and our trustees are using it very wisely to allow us to advance the institution. A particular component of how the endowment supports our operations is endowed scholarships. So that draw that you saw, that a little over 9 million that was on the first slide, some of it supports operations, some of it subsidizes endowed scholarships. Many of you will remember that the campaign that was recently concluded prioritized endowed scholarships or growth in endowed scholarships. And you can see that we indeed did have achieved a substantial growth in our endowed scholarship, going from 29 million in 2016 to more than 52 million in June of 21. While this growth is impressive, there is still an extraordinary need for more investment in endowed scholarships. The college's annual budget right now has about $35 million allocated to financial aid. And so with a draw of 5% on these endowed scholarships, you can see that, very quickly that the support coming from endowed scholarships is, going to be roughly 2.5 million against a $35 million financial aid budget. And so while it is helpful and it is significant, we have roughly 1 million more per year coming than we did a few years ago. We have to continue to prioritize endowed scholarships as being important to the institution. So just to wrap up and summarize my points, first of all, important to understand that the draw on the endowment is an important source of revenue for the operations of the institution, including our financial aid budget. Secondly, endowment per student is a real strength of Lycoming College in the fields in which we compete. It allows us both to compete for students and to continue to provide access to the many first-generation students that this college has historically served. And we've had great growth in endowed scholarships, but we continue to make it a priority for the institution. So with that, I'll turn over to my colleague, Don Hughes, and let him offer the next part of the presentation. I'll be glad to answer questions when the time comes.
Thank you very much, Kent and Chip, and welcome and thank you to the participants today for your participation. I'm going to try to keep my remarks at a somewhat high level, not throw a lot of numbers at you, and in the Q&A session, if I gloss over anything or if you have any questions, please feel free to raise them. I'd be happy to take a deeper dive into to anything that you would like to talk about. As Kent has stated, the endowment plays a crucial role in the financial stability and operation of the college. Admissions has been and continues to be a very competitive process, with factors such as institutional reputation, majors, programs, facilities, and cost playing key roles in the recruiting that we do and the decision process of prospective students. We, along with most institutions in the country, colleges and universities, compete largely on price, but we're limited in our ability to pass along the full cost of an education. We discount our tuition as do most other institutions. We've made the strategic decision not to discount room and board, although other institutions do that. So as we look at statistics like the tuition discount rate, it's not really a good gauge to measure us against peer institutions because others do discount room and board. Now, the discounting that we do to help attract students results in a gap in our revenue stream. And prior to 2021, which was obviously a COVID year, we were running a gap of about $8,500 a student. And just pause for a second and think about that. You know, with each of our students, we have to fill $8,500 to fund that gap in our revenues. And in the most recent COVID year, 2021, that gap was about 11,000, and we expect that to come down post-COVID. And I'm sure you can appreciate that endowment spend or endowment draw is a key factor in filling that gap. We do have to balance, though, the need to manage the endowment prudently and continue to protect and grow it for future generations. So the way we've done that is to maintain what I think is a relatively low and very conservative draw or spend percentage out of the endowment. That percentage spend rate has varied over time, but it's consistently been kept below our peer institutions. In fiscal 20, it was about 4.5% of the endowed balance, and in fiscal 21, about 4.7% of the endowed balance. And as we look at institutional data that's available from our investment advisor, Cambridge Associates, most of our peers are averaging in a range of 5 to 7% draw on their endowments. And if you dig into the numbers further, some are actually higher. And Kent, as you pointed out to me the other day, some of them are quite a bit higher than that 5 to 7% range. But I can assure you that we're very prudent with our spend. We focus on preserving and growing the endowment for future generations. And as we work with Cambridge Associates and look at the data that they accumulate, our spend practice is both on the low end of the spend of their client base, but it's also very much consistent with other institutions in that the methodology that we use, and I've oversimplified it here, but the methodology that we use to calculate that spend rate is consistent with a 70+% of the institutions in the Cambridge database. Our endowment has continued to grow in recent years in spite of the COVID, due in part to Chip and Kent's and Rob's good work with the most recent capital campaign, but also due to investment returns. At June 30 of 18, our endowment was about $209 million. But by June 30 of 21, the endowment had grown to $234 million, a very nice growth rate during that period. Now, we measure our performance, returns from the endowment in two ways. The first and overarching way is that we want to cover the spend rate, and I'll continue to use the 5% spend rate. But we don't want to eat into the endowment or allow inflation to eat into the endowment. So we measure our progress on the endowment initially as 5% plus the particular fiscal year's inflation rate. And that is the bottom row on this slide. You can see that those rates are relatively low compared to the actual rates of return. That's the Lycoming endowment line at the top. The rate of return is 31.9% for the trailing 12 months ended June 30, 21. For the trailing 3 years, it's 11.8%. For trailing 5, it's 11%. And for the 10 years, it's 7.4%. Now, the middle row, the policy benchmark row, is a customized benchmark that was designed by Cambridge to match our asset allocation, the dollars that we have in each of the asset categories that we invest in. And I'm going to turn to that here momentarily. But you can see by just comparing the top row, Lycoming endowment, to the policy benchmark row, that we generally outperform that benchmark pretty nicely for both our short-term and long-term results. We have created what we like to call an all-weather portfolio. And let me just explain to you what we mean by that term. We have a series of asset allocations within the endowment where we invest in different asset classes. And by that, I'm referring to things like stocks, bonds, venture capital, commodities, and the like. And we'll talk about that allocation here shortly. But we've structured the portfolio so that in periods of positive market performance, we capture as much of the upside as we can. But we also have structured the portfolio to cushion us in periods of poor performance so that we don't drop as far as perhaps some other portfolios might in that kind of a period. We're well diversified, as I think you can see from this slide, through our asset allocations. We look at and evaluate our asset allocations at least quarterly, and we perform an annual stress test. And that stress test is something that, while it's not unique to us, is not something that's widely done by our peer institutions. And by stress test, what I mean is that probably the most stressful performance in financial markets in my lifetime was the financial crisis of '08 and '09. And of course, a lot of data was collected during that period on the performance of various asset classes and the whats and whys of all of that. So the way we stress test our portfolio and the way we evaluate the level of risk that we're assuming in the portfolio is that we take on an annual basis the current balance by asset class, so real estate, private equity, fixed income, et cetera, and we apply the rates of decline from the '08, '09 period to those dollar balances. We calculate a numeric result on an aggregate basis. And then as an investment committee, we ask ourselves the question, are we willing to assume the risk of that kind of a loss if we were to see a repeat of the 2008, 2009 period? If the answer to that is yes, we are willing to accept that risk, then no adjustment to asset allocation presumably would be required. If we're not, and this has happened once in my memory, what we do is we look at those calculations again. We adjust the asset allocation until we get to a level of presumed or perceived risk that we're willing to accept, and use then that asset allocation until we go to the next stress test period. I should mention at this point in time that we are slightly overweight U.S. equities. The reason for that is that one, higher allocation, if you will, would tend to enhance our investment performance, but it also is a short-term decision on our part because we believe that as the U.S. economy emerges from this COVID pandemic impact, that the U.S. will outperform other markets. So we've overweighted those U.S. stocks or equities. Now, as far as the management of the endowment portfolio, we have a partnership between the investment committee of the board, the senior officers of the college, and we've engaged a top investment advisor, Cambridge Associates, to recommend investments, recommend asset allocations, recommend managers, all to the investment committee. But it's important to note that we have not given up investment discretion as a committee to our investment advisor. We retained and retain full investment discretion. They recommend, we evaluate and approve ultimately any asset allocation, manager, or policy changes within the management of the endowment. The other key aspect of the management of the endowment that I'd like to touch on is that we've prepared and maintain a lengthy statement of investment policies, spelling out our position on areas such as investment philosophy, investment objectives, asset allocations, and the asset allocations are typically stated in ranges from a low allocation to a high allocation. We as I mentioned earlier, reevaluate that on a quarterly basis. We also have a policy in that investment policy statement relating to rebalancing of the portfolio. And for those of you who don't know what I'm referring to when I say rebalancing, let me give you a fairly recent example. At the depth of the COVID-related financial market swoon, March of 20, we took a look at the asset allocations in the portfolio. And as you might imagine, our investments in stocks worldwide had declined and declined pretty substantially. And you saw that on one of Kent's slides when he showed the endowment going down. I believe it was to $184 million at one point. And that was largely in our equities portfolio. But the interesting part about the construction of our all-weather portfolio, our fixed income or our bond portfolio, which is a very short duration, very high quality bond portfolio, the value of that asset class in our portfolio actually increased pretty significantly. So as we looked at both of those occurrences, we determined, working with Cambridge Associates, that what we wanted to do was to sell some of our bond portfolio, recognize the gain that we had in that portfolio, not only from COVID, but from over time, and that we would invest those dollars into stocks, primarily US stocks, because we, as I mentioned a moment ago, we felt and feel that they have the most upside room to move. And so we invested those dollars in stocks at very depressed valuations. That turned out to be a fortuitous event because we almost doubled the money that we had invested in US stocks by that one small rebalancing decision. So that's what I mean when I say rebalancing, and we go through that exercise quarterly. The investment policy also has a spending policy, and we've talked a lot about spending policy this morning, so I won't spend any more time there. It also elaborates the roles and responsibilities of the investment committee, the officers of the college, the investment advisor, the managers and custodians that we work with. And then we also have a section in there on conflicts of interest to make sure that no one on the committee or anyone we're working with has a conflict. Now, this statement of investment policies is updated every few years. It's reviewed by Cambridge Associates. They have a tremendous database of information from similar institutions. So we blend and mix other policies in there to make sure that our investment policies are truly best practices, and I believe that they are. Turning to current asset allocations, we, as you can see, have a significant allocation to global equities of 68%. That's at the high end of our allocation range in our policy statement. And as I've mentioned, that has an overweight to US equities built in. We also allocate to hedge funds, so-called alternative assets. That's to provide us with downside protection in a downside market, so it cushions our downside if we get the inevitable, or when we get the inevitable correction. We invest in real assets. In this case, we've allocated about 4% to real assets. By real assets, I mean commodities and oil and gas. And we've allocated there because we believe that as the US economy emerges from this COVID problem, that commodities will gain dramatically. And in fact, over the last 4 or 5 months, we've seen tremendous gains in commodity pricing. You may have noticed that as you fill your car with gas, that it's become increasingly expensive. And over the last year, we've gone from $40 a barrel oil to, last time I checked, $81 a barrel oil. And projections that I'm seeing would indicate that we're headed to 100 or perhaps higher in the not too distant future. We have an allocation to private equity and venture capital of about 2.5%. That's to bolster our returns. It's a very low allocation compared to other institutions. That's in part due to the fact that probably 10 or 12 years ago, we stopped allocating investment dollars to private equity and venture capital. We did that because we didn't believe that we were getting access to top tier funds. And to really get good returns out of those that asset class, you need to be investing in top tier funds. That's recently changed. We've been able to gain much better access to top tier funds. And I would see us taking that allocation from 2.5% to probably closer to 5% over the next couple of years. We've made 4 new investments just in the last couple of years in that space. two in the venture capital area, one in a buyout fund, and one in a private equity fund. Lastly, we have fixed income in the portfolio of about 15.5%. That's in there also to cushion our downside. But we have and by the way, that's at the lower end of our available allocation to fixed income and cash. But we have a delicate balance that we have to maintain there. In that you're all aware that interest rates are very low, that fixed income doesn't pay very much this year. And we're also obviously seeing rates increase, and there's a lot in the financial press about rising rates over the next couple of years for a lot of reasons. And when rates rise, the price of existing bonds that are at a lower rate drives down or is driven down. So we're trying to balance the downside protection aspect of fixed income with the risk that we have of rising rates. So that's why we're at a lower allocation there. And we just wrap up by saying that the college's investment approach is consistent with best practices as best we can determine them of other colleges and universities. We have a very well-controlled process that is a partnership between the investment committee, senior members of the administration team here at Lycoming, Cambridge Associates, our investment manager. We prudently manage our endowment and our spend for the benefit of both current and future students. I believe that we've engaged an excellent investment advisor that thoughtfully advises us on this. We've turned over our manager list to a certain extent over the last 4 or 5 years and brought better quality managers into the portfolio. And something that's near and dear to my heart, we have a very low level of fee compared to our peers. And fee, of course, is the price that you pay for an investment manager to actually manage those dollars. We routinely fall lower than 1.7% annually of fees, and all of the rates of return, by the way, that I quoted earlier are net of fees. So we have a very low cost of management of our portfolio as well. And I guess finally, I would say that we remain committed to our long-term approach, believe that the portfolio is well positioned for the future needs of the college and our students. So with that, I would say thank you and be happy to, Chip, to field any questions that anyone has.
Thank you very much, Don. Thank you, Kent, as well. I hope that you all have found this informative and an ability to sort of see intimately the role of the endowment broadly in terms of the health and wellness of Lycoming, but also its role in higher education, and then specifically the ways in which we have stewarded and managed those funds here at the institution. So I will welcome some questions. I see them trickling in now. The first one that was raised by Jim. And Jim, great to have you with us. I hope all is well up there in New England. Jim raised a great question and noting two institutions up north, both Dartmouth and Harvard, that have sort of noted their divestment in fossil fuels. And maybe I'll ask this just a bit broader question for each of you, and that is, what are the ways in which we monitor sort of the social ethical responsibility of our investments? Because I know that is something that we do on a regular basis, and the investment committee explores and makes those kinds of decisions. Is that something that you could speak to, either or both you, Don, or
Sure, yeah, sure. And I might expand that out too, to add another element to that. And those same institutions, and you see this at Princeton and Harvard, particularly, have reduced their commitment to private equity and venture capital as well. I think the reason for that is that they had gotten grossly overweighted in that area, and the cost of that investment was really no longer worth the returns that were being generated. They also, I believe, saw greater returns in equities and stocks, and have moved some of the dollars there and some of the dollars into hard assets, also real estate and other areas. As far as ESG investing, yes, we do monitor that. We have a very low commitment to commodities, in part for that very reason. We also split our commodities investment not just to oil and gas, but also to other hard mineral and other commodity areas, all of which benefit. And we try to maintain a balanced approach between ESG and the need to grow and support the endowment and the endowment's return. So that's how we've done it pretty much in the past. Kent, did you want to add anything to that?
Sure. No, I think we're very well aware that several high-profile institutions have announced changes in their investment policies with regard to fossil fuels. And we are obviously monitoring the extent to which that would become a larger trend. I think it's, you always have to, there's lots of ethical considerations that go into all operations of the institution, and clearly this is an important and relevant one. On the other hand, Harvard and Dartmouth have flexibility in implementing these kinds of policies that would probably be different than what we would have available. And Don and I haven't talked about all the technicalities of that, but I do know at a previous institution that I worked at, this was explored. And when you have managers who are investing, it becomes very complicated to do a divestment policy, as opposed to Harvard definitely has a manager of their own, and that's a whole different thing. But we are obviously paying attention to that as an institution, and trying to balance the many ways in which we evidence our commitment to the transition that is taking place and will take place. Our Clean Water Institute, our biology field station, our curriculum will likely add environmental science, which will have climate change as a significant element of it. So good question, and an important value ethical discussion for us to have as a community.
And Chip, if I could just add one thing to that, a specific example that occurred, I don't know, a year and a half ago. One of the recommendations that Cambridge brought to the investment committee was an investment in a fund that was essentially an activist investor. And for those of you who don't know what an activist investor is, it's a pretty well-heeled group of individuals. There are some big names out there that I won't mention, but what they do is acquire an interest in a business and try to make big changes to that business, whether it's breaking it up, it's divesting pieces of the business, changing management, all aimed at purely financial goals. But many times involves very, very messy processes, a lot of legal activity, and a great deal of headline risk to the investors. We chose not to do that because we didn't think that would reflect well on the college and the ethical standards that we try to maintain here. So we did not do that investment, but that's just a point in illustrating that we do deal with that. It's somewhat routine, but we are definitely mindful of that whole question.
Thank you both very much. And I'll make just one small comment too. There are instances, and I recall one a couple years ago with the investment committee, in which you can have kind of a flashpoint or something that hits the national radar, or something that has not gone well. And our investment committee can say to Cambridge, are we invested in any of these companies? Say an oil rig off the coast of whatever. Do we have holdings here? That was not the particular case, but those kinds of things, very quickly we can assess where we might have some exposure or investments unknown before a particular crisis. But those are kinds of things that we evaluate as well. So on a related question also from Jim, In our equity portfolio, what is the mix of passive versus active management in that part of the portfolio?
I don't have that number for just the equity piece of our portfolio, but I can tell you that overall in our portfolio, about 30 to 33% on average is passive, and the balance is active. And that's up from when I first became chair of the investment committee, which is now 8 years ago, I guess. That's up from near zero. And through that period, it was a very good performance period for passive investors. And that's one of the reasons that I mentioned our fees less than 1.7%, because we use about 30% passive investment vehicles in the endowment portfolio. That has the effect of pulling those fees down as well. I'd hasten to add that we're now in a period, and I suspect we will continue to be in a period for some time, where active investors, essentially investment pickers, generating what's called in the trade alpha or manager-specific returns, are both doing and have done, and I believe will continue to do better than the passive. So you're starting to see a lot now in the financial press about a desirable shift between passive strategies and active strategies, and that's something that we're talking about at the investment committee.
Thank you, Don. You may have, Amy has raised a question here as well. Amy, thanks for this question. And since it was submitted, you have, I think, touched on some of it, but I think there is an interest in describing diversifiers perhaps a little bit more as a piece of the portfolio, and what really all is included in there, and the kinds of or the sort of suite of offerings that we would include in that piece of the pot.
Yeah, well, the diversifiers, and I just very broadly describe them as being hedge funds, have been a hot topic of conversation for the investment committee. The standard allocation to so-called diversifiers in a portfolio like ours, an endowment in the $200 to $250 million range, would probably be 15 to 20%. And we were at that level of diversifiers, and the types of investments in there were very broadly defined. They were opportunistic investments that focused on investing in companies that they thought were either going to be active acquirers or would be sold. So a transactional kind of a fund. They were traditional long-short hedge funds that would buy some stocks, typically smaller stocks, and sell short other stocks. And then there were some quantitative funds that ran very sophisticated mathematical models to allocate their investment dollars around. What we found over time was that the returns of those funds just weren't that good, and the issue there, and probably still is the issue, is that many believe that hedge fund model is just broken, that it isn't working in this unique environment, and that's probably been true since 2008, 2009. So what we've done is we've over the last year, we've totally shifted our strategy towards, and I'll continue just to generically call them hedge funds. And we've moved to a much smaller number of hedge funds. We've cut our commitment to these so-called diversifiers in half. So we're now down closer to 10% with those investments. And we're going to more traditional investment products that are making, direct to an earlier question, direct investments, and they're long investments. They're typically not short investments. So what we've done is go to more traditional products in that area that still invest in areas that are not highly correlated to the broader stock markets, that give us downside protection, and that have had lengthy operating histories generating strong performance. So hopefully that answers your question, Amy, without getting too far into the weeds.
Thank you, Don. Very helpful. I will just pivot for a moment, and as we, I think we've wrapped up some of our formal questions here, and so I'm going to ask maybe both of you, Don in particular, if we wanted to pull out our crystal ball for a moment. This has been quite an interesting time, and in the markets, and both globally, domestically, and what is the investment committee thinking about? What keeps you awake at night at the moment, and where do you think the college would need to pay particular attention over the next fiscal year, and perhaps even a little beyond?
Mhm. Well, I think that the thing that keeps me awake at night is the next correction. And without question, we are going to have a next correction. We have not had an official correction in markets, which typically is defined as a down move of from 10 to 20% in over a year. And we also, at least until very recently, haven't even had a 5% correction. Now we've got a rolling 5% correction that is happening right now, but it's rolling through sectors and specific companies as opposed to being a broad-based correction. We see the big techs going crazy to the upside, but as you get below those big techs, there are a lot of companies that have or are or will be correcting. So we're very much focused on the U.S. stock market. We focus there, as I mentioned, I believe, in my comments earlier. We believe the U.S. markets are safer, will perform better than non-U.S. markets. That's why we're overweight. And we've also cut back on emerging markets. The emerging markets have been hurt badly, and we may be cutting back a little bit further on emerging markets. But Chip, just off the top of my head and thinking about, what I worry about with our portfolio is the downside. Are we adequately protected? Are we focusing on the future, which is very difficult to do because most financial professionals focus in the rearview mirror and don't enjoy pulling out their crystal balls and thinking about what the future is going to look like. Mm-hmm. So hopefully that's responsive to your question.
Very much so. Thank you. Thank you. Kent, would you like to touch base on that one too, or? We
Sure.
did have another question pop in, so go ahead and then we'll get to this question.
Well, there are certainly many things that keep me up at night as president of a college. Don's level of knowledge about markets is so broad that I'm not going to attempt to comment on the direct things that he noted. However, when Don talks about the downside or a correction, clearly the thing that a college president worries about is how might this impact our operations? How might this impact our ability to continue to invest in the quality of the educational experience that we're offering at Lycoming College? The fact that we have a 12-quarter trailing average for calculating the draw and the endowment cushions that to some extent. So, if there is a 10% correction, it doesn't mean that our draw is going to go down by 10% the next year. And that's one of the very wise things that our trustees have done. And I think the other part of, we have a phone going off here, of course. The other part is not so much about performance of the markets, but if one looks at the economy more generally, there is a growing challenge for the families that will be coming to college, including middle-class families, in being able to afford and access higher education. A lot of the wealth creation that we have been so fortunate to enjoy in our endowment has not necessarily impacted the middle class. And I think, that is something that I worry about in terms of middle class and families that are first generation as well, continuing to afford college and our ability to continue to make it possible for them to do so. And that'll take me back to my point that for us to continue to focus on endowment fundraising is a way that we can complement what the endowment does for the institution. So I worry about the same thing, but I'm somewhat relieved that we have that 12-quarter trailing average, which I know will cushion an impact of a correction on the institution.
But Ken, to your point, there's also a demographic challenge that all institutions are being confronted with, and you can speak to that much more eloquently than I can, certainly.
Yes, and I think we've talked about this probably in a recent webinar that I did in State of the College, but the consensus now is that we know what the birth rates were 18 years ago or 15 years ago, and the consensus prediction is that the last 3 years of this decade, we're going to see roughly a 12% drop in college age population. And that is on top of about a 10% drop in the college age population over the previous decade. And so, just for like any business, demand is less than it was. Unlike many businesses, colleges or industries, colleges don't go out of business. So supply is not correcting nearly as rapidly. And so the downward pressure on price and tuition discounting and the need for the endowment to help cushion all of that is illustrated. And that keeps me up a lot, as I know it does Don and the rest of the trustees. And we're trying to be very smart in our strategic planning right now to position ourselves to compete well as competition intensifies.
Thank you both. I think really additional deep, thoughtful insights there. And since then, we've had two additional questions, and we do have just a few minutes left, so we'll try and attend to that. But a question from one is, and this is part of the crystal ball perhaps, but we've not mentioned inflation. And so the question is how much the investment committee, or even you in particular, Don, are concerned about or mindful of inflation, and looking at your rate of return for the institution. It certainly puts more pressure on an investment strategy in periods of higher inflation. And so what are you seeing? What do you anticipate, or how is that impacting things?
Well, until fairly recently, the most popular line was it's transitory, right? So there had not been a lot of focus on that, other than to say that on long-term inflation, other than to say that we've shifted our asset allocation a bit over time, chipped around the edges, brought more stocks, equities into our portfolio to try to enhance our return. Commodities benefit from inflation. Some of our diversifiers, alternative assets, whatever you want to call it, benefit from inflation. But stocks don't necessarily benefit from inflation, especially outside the US. So I think that while it's not been a huge point of focus, we've discussed it, we've tweaked our asset allocations to be responsive to the current environment. But I think going forward, the questioner is absolutely right. It's going to be a much greater point of focus for us as we address go forward asset allocations.
Thank you, Don. And one additional question here from Pete. So glad you're with us as well today, Pete. Good to see you here. Some more particular questions about Cambridge. How long have we been utilizing Cambridge, and how is it that we benchmark their fees relative to our peers or other educational institutions? So what are some of our sources for information there?
Well, fees occur at 2 or 3 levels. We have a fixed fee relationship with Cambridge. We're fortunate to have a person on the investment committee who works in the space of finding investment advisors for colleges and universities. She has a very good finger on the pulse of all of that. So we have an excellent, I guess I could call it an outside source, but she's really an inside source on that kind of thing. And there's publicly available information on the fees of the investment managers that Cambridge recommends to us, and that do the day-to-day physical management and hard work of managing the portfolio. And I've spent the last 25 years of my career managing hedge funds and private equity funds. So I still have a fairly good sense of fees in that sector. So we have a number of points of input and contact where we can, manage those fees. As to the first part of the question, I believe we've now been with Cambridge for about 12 years. We've had an excellent relationship with them. The way we've managed that relationship mostly has been through the members of the Cambridge advisory team that work with us. And we've changed members of that team out over time and brought in other members that we felt perhaps were more appropriately suited to our needs. We recently, recently, a couple of years ago, when I mentioned that we started to allocate more time and dollars to private equity, venture capital, that sort of thing, we requested and they brought a private equity specialist onto our team. So we've just had a really good relationship with them. We talk routinely about, well, should we go out and seek proposals from investment managers, my personal, or investment advisors, excuse me. My personal experience has been, and I think the academic research supports this, is that you rarely gain much from going through that process. If your advisor is generating good returns, if you're happy with the service, the fees, the performance, it probably pays just to stick with them and work with them. So it's been a good relationship, although it's been a long-term relationship.
Great. Thank you very much, Don. Very helpful. And I think that that closes out our formal questions. Sorry, Ken, please.
I just want to make a comment that hopefully you can see how much the college has benefited from having Don as a trustee and the vast knowledge and thoughtfulness and expertise that he brings to that work. I think, Don, you had maybe just stepped into the chair in 2013 when I took office. And at that time, there were some significant issues that needed to be addressed. And Don did a terrific job leading the investment committee through addressing those issues. And I have no doubt that as a consequence, we participated more fully in this recent market run up than we would have the way we were positioned.
Had we not changed, yes.
So hopefully you can all see how much we benefit. And this is not my area of expertise. And what does help me sleep at night is knowing that people like Don Hughes are involved in our investment committee.
Yes, indeed. Yes, indeed. Well, as we close out, we are at the hour. Looks like my Zoom feed is dropped, but hopefully you can still hear me out there. But wanted to also express our sincere thanks to Kent and Don for not simply their time today, but what has been an extraordinary investment in this institution, both personally, professionally, and with their expertise. We are all collectively benefiting from that. I also want to thank those who have joined us today. You yourselves are folks who invest in this institution and care about its future. And so we thank you for all you continue to do to make Lycoming a truly first-rate institution. Rob, thank you for your help today. Thanks for a great Friday afternoon together of lunching and learning together. And I hope you all have a great weekend. Thank you so much.